Hello guys, what is happening and welcome to tonight's live stream. So there's a couple of things that I want to go over. We've had, again, just massive moves in the bond market today. But as we turn the corner and head into this recession, and believe me, like I say that with a lot of confidence because the probability of Canada entering a recession is really high now. You've got the yield curves inverted. You've got all kinds of different things that are happening. Interest rates are rising. Bond yields are exploding. All different things. And one thing which is extremely important and a massive key to the puzzle is actual earnings, because obviously actual earnings are a major part of the economy. If people's wages, to put it simply, if people's wages are negative, and I'm talking about negative in real terms, we only talk about in real terms on this channel. Anytime I'm talking about home prices, wages, anything like that, it's real terms. So in real terms, wages are down, and that is a bad thing. You cannot have wages that are negative and a booming economy. The two don't go together. Like, that is essentially a recipe for a recession on its own without all the other things that we've got going on, which was a boom in asset prices, oil prices at all-time high. All these things line up and always tend to happen right before a recession. So let's take a look at the data now for the weekly earnings. So I'm going to bring in, so you can see it right here. This shows the year over year wage growth. And you can see right now it's at around 2.5%, 2.4%. But let's go over to inflation and see what that's at. Well, that is at 5.7. We don't have the other month yet for March for the wage data, but it's at 5.7%. So then all you've got to do is to just subtract that 2.4% from the 5.7% inflation rate, and it's 3.3% negative real earnings. That's a lot, guys. People's income going down by that much is only half the story as well. And that's something I really want to hammer home in this stream is, these bogus numbers that the government put out about inflation, like saying it's at 5.7%, like obviously we know it is way higher than that. We know year over year inflation, if you're measuring it as the shadow stats data using the 1980s basket, you're talking 20% inflation. So if the inflation rate is 20% and wages are only growing at 2.4%, then that's just awful. That's god awful. You're talking depressionary levels of stagflation. Like, that is unprecedented to have real earnings fall by that much. But truth be told, that is the reality, guys. Real earnings are down 15, 16%, whether people like it or not. And that's the reality. And when people's earnings fall by that much, they can't afford to pay all this money for these overpriced assets like real estate, anything like that. Regardless of interest rates and what's happening with interest rates, you would see it start to affect the market with just the negative wage growth. Like, that on its own has huge dramatic effects on the economy. And, some other things that I want to go through that I feel like are so important are bonds. And just like, to put it in layman's term, bonds are just debt. They're just packages of debt, and they pay a yield to investors and they're sold on the open markets. Well, the thing is, these bonds have been falling in price. And when they fall in price, that means the yield goes up. So the company that's issuing the bond has to pay more to service their debt. Now, the thing is, the bonds have sold off so much now. Some of these bonds are at, forget the great financial crisis, forget 2018, forget 2014, all these times where we've had events that have affected financial markets, 2020 even. And just take a look at this chart. So I'm going to pull up this chart that is a iShares core Canadian short-term bond. So a lot of these companies, they do their debt through short-term bond. So I'm going to try and put this on a chart, which makes it more easier to see, because these charts aren't they aren't exactly the easiest. So let's go monthly. No, it looks really bad on that. I'll try and show you like this. It really doesn't matter that much anyways. But if we look at this, you can see with this bond, if we stretch it out to the maximum, 2008 was here. So you were at this level in 2008. You're now like 2020, what happened in 2020 is around here, like it doesn't even show up. And then where we are right now, this bond is down at like, and I'm not sure why. Oh, wait, I gotta scroll over. Oh, no, that is right. Yeah, so this goes all the way back to 2001. And you can see that this bond is sitting below, like it's the lowest low. Like it's at all-time lows, like lower than the dot-com bust, lower than 2008. It's at the lowest level ever. So what does this mean? And that's the real thing that we have to ask. What does this mean? It simply means that business bankruptcies are going to soar. There's going to be waves and waves of businesses that are going to go bankrupt. So Canadian tech companies in the US, they're particularly vulnerable because they're generally money-losing companies, and they generally are able to function by issuing lots of bonds. And if they can't afford to service that debt anymore, well, then it's the end zone. They have to go bankrupt. So the thing is, you can have a legitimate good tech company or whatever, but a lot of these businesses aren't making money. And that's what people fail to understand. And that's what you see when you see these stocks just down 80%, something like that. The stock market just had the worst start to the year, the worst 4 months start to the year since the Great Depression. So yeah, the stock market is still high when you look at it in nominal terms. But if you look at like how much it's declined over the short period of time, we're talking back into the Great Depression. And that is just something that people aren't putting two and two together. Like, people think everybody is trying to rationalize. That's what I see a lot of right now. Everybody is trying to rationalize why their particular city or state or market is going to be different. It's going to be saved. And they don't realize that the whole plumbing of the financial system affects the whole entire country altogether. And Canada is heading into a banking crisis. I believe we're going to see a banking crisis emerge probably over the course of the next 12 months. And people just think, nah, Luke, you're crazy. Like, a banking crisis? That's not going to happen in Canada. Come on. Like, really? Well, when all these companies start going bankrupt and defaulting on the debt, then that debt isn't being repaid to the financial institutions. And you can already see some of the over-leveraged financial institutions, their stock price is sinking like a ship. And again, people will be looking at that thinking, why is that happening? I can't put the pieces of the puzzle together. And it's really just because they're a sinking ship, and they're one market fluctuation away from bankruptcy, like Lehman Brothers, companies like First National Corporation and everything like that. First National, whatever they are, a bank or lender or whatever, but they're particularly affected. And that is why I went in to short positions on these banks a couple of weeks ago. And the thing is, I'm disclosing that for obvious reasons. And a lot of YouTubers don't do that. They say, oh, yeah, I'm going to say everything about this, but I'm not going to tell you that I'm long or short or I have a bias, because I do have a bias, because I'm short on it. But I'm short for a reason. I'm not just shorting it because I think there's going to be a financial crisis. I'm shorting it because I've analyzed all the financials, and I'm like, how, like, this system is so broken. It is exactly like 2008 in Canada. And it's exactly the same thing that is going to cause the demise of this. So it is going to be extremely different to what people think. This recession is going to hit a lot of people really hard. So it's like, it's kind of crazy, all these leverage ratios that are just out the window. You've got companies bringing in $100 million and they got billions of dollars in debt, and their income, if it just fluctuates a little bit and their debt price goes up, they're gone. They're wiped out. All the Canadian banks are like in distress zone if you look at different indicators. And I'm going to be doing a video on this. Well, I've done a video on this. It's all ready to go. It's going to be coming out tomorrow or Wednesday this week. And it's about the banks. And it's just a snapshot of what I've really found out about the banks when I've been going into their financials and everything like that. But, it's absolutely kind of insane when you really think about it, when you really put it into perspective where the economy is right now. And you just can't get away from the fact that real wages are negative. We've now got interest rates going up. The cost of servicing debt is going up. The cost of everything is going up. And that has massive implications, not immediate implications, but massive implications over time. So another thing that I wanted to flip to was, I couldn't believe it, but CTV, one of the state propaganda news media networks here in Canada, put out an interesting article that I thought was kind of interesting, because what these state media organizations that have massive political affiliations, they are now introducing to these people, like, because these are wide reaching media outlets here in Canada, because they're funded by the state. And they are now saying about a recession. Oh, there might be a recession. And now that is entering the mainstream. That it's going to happen. Like, it's going to happen. People are going to ignore this. They're going to downplay it. They're going to rationalize it, especially if they've made poor financial choices over the past 2 years, which we know a large percentage of people have. And that's just the reality of it. Take it as it is. But it's, anyways. So as inflation driven by the pandemic and Russia's war on Ukraine continues to impact the economy in Canada and around the world, there are serious concerns that a recession could be on the horizon. I've been saying since last year, a recession could be on the horizon. Earlier this month, Deutsche Bank, and don't read into too much. These bankers get it wrong all the time, as I'll show you. But just it's the fact that they're putting this out there that I want you to think about, not the banks saying this is going to happen, that's going to happen, because really just ignore what the banks say. Earlier this month, Deutsche Bank became one of the first major banks to forecast a US recession later next year. At the time, the bank said it expected to see a mild recession, but on Wednesday, it revised its forecast. warning a recession could be significant. Former CIBC World Markets chief economist Jeff Rubin says he agrees that the outlook and expects a recession could be even worse than Deutsche Bank prediction. It probably goes without saying that outlook is equally valid for the Canadian economy as it is for the American economy. It's even worse for the Canadian economy. Little do Canadians know, because of the asset bubbles, because there is so much debt in the system. The system is completely overwhelmed by debt. All the pipes are bursting, which have the debt running through. And anyway, I'm getting a little bit off topic. So he told them on CTV's Your Morning on Thursday, the reason why that outlook is the most likely to occur is because runaway inflation has always led and ended in significant recessions for the past 50 years. So I agree with him about that. Last week's Statistics Canada reported that Canada's inflation rate had risen to 6.7% in March, a 31-year high. In the US, the Department of Labor 2 weeks ago said inflation spiked to 8.5%, the highest since 1981. And we've actually covered about that and how the 1980, like on previous live streams, you can go back and look at that if you're interested and you haven't seen it, because it's quite interesting when you go through the different ways of measuring it, and we've done it before. The supply chain constraints around the world continue to contribute to higher prices on everyday goods. On top of that, sanctions on Russia imposed by the US, Canada, and Europe. It's good that they're actually at least saying it, calling a spade, because it is the US, Canada, and Europe's doing that. The sanctions are there and causing the skyrocketing prices. And Europe have propelled skyrocketing prices for energy and wheat. The Bank of Canada and the US Federal Reserve have attempted to curb inflation by steadily raising interest rates. I mean, that's a funny one, isn't it? Let's be honest. 2 weeks ago, Canada's central bank raised its key interest rate by 0.5 point to 1%. The US Fed last month approved a 0.25% hike to 0.5%, and Fed Chairman Jerome Powell has said the bank needs to raise rates expeditiously to address inflation. But Deutsche Bank says it expects the Fed will hike rates so aggressively a recession could ensue. And what's the alternative to that? Like hyperinflation, inflation spiraling out of control. I mean, the fact is they both end in a recession. So it's kind of stupid to say, oh, the Fed is going to cause the recession, because the recession would happen with inflation anyway. All I would say is the Fed is just going to expedite the process, but yeah, it would have happened on its own course anyway. It's like we've said before on these live streams, pick your poison, inflation or interest rates, they end up at the same place. Typically, a recession leads to deflation or slower inflation, typically, but not always, as declining demand for goods and investment drives prices down. However, in the worst case scenario, Rubin says we could see stagflation. It's funny he says that, because we're already seeing that. The only thing that we haven't got is the higher unemployment rate, but that's because we're early on in this. We are literally like 14, 16 months into this high inflation. So it's really too early to say, but this would have happened anyway, because businesses can't pass on those inflation costs, wages aren't going up at the pace, so people are going to cut back, yada, yada. I don't need to go there. You're all smart enough to work that out on your own. I think that's a real concern. The World Bank just put out a report saying that the world faces the largest inflation shock that it is seen in the last 50 years. And there's unique factors happening here that will not necessarily be remedied by a recession, he said. Russia is the world's largest resource producer, and if they continue the war, then we may see pressures on resource prices, even with a recession, because so much of supply from wheat to oil will be taken off the market, Rubin continued. But not all economists are predicting economic doom and gloom. In a forecast published last week, Goldman Sachs says it expects the US economy to avoid a contraction given the red hot job market and that households have more savings at their disposal compared to the onset of previous recessions. The Wall Street Bank says the likelihood of a recession is 15% in the next 12 months and 35% in the next 24 months. So that's absolutely ridiculous because when the yield curve inverts, that's like a 90% probability. So I don't know who their economists are. But let's use Goldman as an example here. And this is why I said take those bank reports with a pinch of salt because they are not accurate at all most of the time. And here you go. 2007, Goldman tells paper US recession unlikely. So there you go. Same bank saying that in 2007, a recession is unlikely. And here they are again, same bank saying a recession is unlikely. So maybe we can take that as a sign a recession is more likely. I don't know. But anyway, the point that the media is putting it out there is an important one because they are now getting that psychology to change the mindset. And what's interesting about this is you really got to think, why would they do this? Why would the state do this? And the only reason I can think is because they are going to have to continually raise rates, even going into a recession, because that's their only way of saying, look, we're trying to do something. We're trying to quell this inflation, which is collapsing the economy. Or what's the alternative to that? The alternative to that is they go, okay, we're going to cut rates. We're going to do quantitative easing, and the currency will just spiral out of control. And we're already seeing that with what's happening with the yen in Japan. Like, they are going to have to reverse course. Like, they've started to basically try and do yield curve control. And they're going to have to reverse course on that because the inflation is going to get out of control because their currency has lost too much value. And what we're beginning to see is the emergence of currency wars. And when that really happens, it's actually led to wars in the past. But the thing is, like the Second World War, for instance. But the thing is, this is very, very important to remember. A lot of people think that if we go into a recession, a lot of people think that the central bank is going to cut rates and quantitative easing, here it goes, and we're all cooking on gas, asset prices to the moon. But if inflation persists like it is going to, and I believe it's going to, then there's not really much chance of that happening, because even if they did that, that would just add gasoline to the fire for inflation, possibly could lose control of the currency altogether. So they're walking a tightrope of what they can do. They're backed into a corner, the Fed and the Bank of Canada, and they are screwed. There's no way that they can save this and get the economy to avoid a recession. It's just not going to happen. And all I see is this recession / depression that we're heading into is the one that was going to happen in 2020. And that's why QE doesn't work. We've just literally, I've been saying this again for a year. QE is just can kicking. It's just can kicking. You're eventually, and not only is it can kicking, you're making that can heavier and heavier and heavier. So eventually, when it hits whatever it hits, it does more damage. So the recession's even worse than if you just let it happen to begin with. And that's the big problem. None of these things work. So you can't, and especially not in an inflationary environment. So the thing is, we really have to ask the question and start thinking about what's going to happen moving forward in the future and prepare accordingly. Like I've been saying, people just need to take on side hustles. people need to be thinking, I even said I can't even remember whether it was a comment or somebody on Twitter or whatever. But I basically said to them, do whatever it takes, sign up for Uber, just have it ready to go just in case, the worst happens. People are going to be affected. We're going to see big companies going bankrupt, and it's just not going to be an environment that anybody is used to here in Canada. I mean, most people, the recession in the 90s, most people were too young in Canada that they experienced that. So they have no idea what a recession is. They have no idea how to prepare for a recession. They have no idea what happens to asset prices. And that is evidenced in like what's going on right now. You still have people who are trying to lock in low rates for home loans, like buying at the top of the market. Like it's insane. But these people think nothing can go wrong. Housing prices always go up. But the recession is really the killer, because that's when you're going to get higher unemployment. Because ultimately, guys, the rise in the bonds, the fall of the bonds and the rise in the yields, that means that more businesses go bankrupt, default on their debt. But in turn, it means more people are unemployed. And that means that more households default on their debt, end up in foreclosure, bankruptcy, all those different things. And what people fail to understand is recessions like the one we're going to see are going to be pretty damaging. So, like, let's say you're a landlord, for instance, and lots of people are losing their jobs. Your tenant loses their job, and this was a feature in 2008. So your tenant loses their job, fine, you'll just evict the tenant, okay? So that's quite a lengthy process anyways, but the courts are already clogged up with people trying to do the exact same thing. Do you think they're scaling up the court system to deal with the amount of bankruptcies, the amount of tenant evictions that are going to be put through? Of course not. They're not doing that. In fact, they've got even less staff on hand than they had before the pervasive sickness started. So it will just be crazy. And the courts were absolutely nuts in the US and completely backed. And that's why a lot of the time these things end catastrophically for people who bet on these bubbles continuing. And the whole economy, as we know it in the United States and Canada, it's a bubble economy. Without the wealth effect from the stock market and the real estate market, you're going to see what's really there. And it's nothing. The economy isn't strong or anything like that. The economy has only been just plowing along, and it wasn't even plowing along well before 2020. Everybody was forecasting Canada was heading into a recession. That was part of the reason I sold most of my stocks heading into 2020, was we got a negative GDP print. Everything was lining up. The yield curve inverted before that. And that's why I took action. And then but I never knew it was going to be what it was. It was just taking action, preparing for what was going to happen. But these things are just like this. This is depressionary level stuff, and I don't think that's what people understand. And even we're coming up with a plan. We're thinking that we're going to go traveling and figure it out, and just go traveling essentially, because we don't want to be here. We'd like to see the rest of the world, and we'd like to do some traveling to places that we're possibly going to think about living, like Panama, Costa Rica. Those places are the main places that we're looking at. So we want to do a lot more traveling around. And you've just got to have a plan, like, whether your plan is selling whatever on Facebook Marketplace that people are going to need, whether it's, whatever it's doing, you just got to have some form of a plan. But there are loads of different things right now that are easy to start, that require very little amounts of money, that you can start as a side hustle or even just have ready, like Uber. like I said, because again, when everybody's unemployed, everybody is going to be applying for Uber. They'll probably shut off. They'll probably say, we've got enough drivers, guys. We don't need any more. And then if you've already got that done, you've had your car checked out and all the other things you've got to do for Uber, at least you have a backup plan. And I would just encourage everybody to think about a backup plan that suits them, because ultimately it's just absolutely, crazy. And I'm not going to be the guy who's optimist or anything like that, because there is no reason to be optimistic right now. And really, people who want optimism, they just want to rationalize stupid decisions they've made. And it's crazy anyway, guys. But as you know, these bonds being at 2001 levels, everything that's going on right now is an absolute train wreck. And if you can't see that this train is heading for a cliff, then there's no help. There's no help. So anyway, like these things, I mean, one last thing I just want to show you real quick is it's not just that bond I showed you earlier. It is every freaking bond on here. Like all these other bonds, they're all just crashing. So this one right here is at 2008 levels. All these bonds are just down, 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 absolutely down and crashing. And what this does affect as well, which I haven't gone over, is mortgage-backed securities. Mortgage-backed securities are essentially bundled mortgages. And when bonds are dying like this, mortgage-backed securities are dying even harder. So that means if you've got tons of mortgage-backed securities that you can't shift and sell, you have to keep them in-house. And what that means is when people start to default on their loans, guess who now owns all that risk? It's not the investors, it's the financial institutions. And nobody in their right mind is buying MBS right now because the yield on it is ridiculous. So MBS has way further to fall, in my opinion, and that will just eventually lead to banks not wanting to give you a dime. They won't want to lend to you for a home loan. So, and they may even start calling in other people's lines when people start to default, doing all kinds of things, because the bank isn't your friend. They don't give a flying toss about you. So it's really just where it is, guys. But anyway, it's kind of crazy. And, when you think about 2001 and what happened there and how Canada avoided 2008, they avoided 2008 because they didn't have that dot-com bust. Had they had that dot-com bust, they would have been hit just as hard in 2008. But they didn't have that dot-com bust. They inflated the bubble in 2008 to unprecedented levels. And you could very well see prices going back down of assets to 2008, 2009 levels, as is already happening with bonds and stocks, which have just been annihilated. So don't try and hide behind going, oh, the supply of housing, everything like that. There's no rationalization for this. Just make sure you're in a good position if you do own a home, that you're not over leveraged, and you can continue to meet your obligations of your finances. And then you should be able to ride out the storm. Unfortunately, for a large majority of people in Canada, that is just not the case. They are completely over leveraged, oblivious to what's happening, and they are literally going to get their head chopped as we head into this. And unfortunately, there's no warning those people, because they have been brainwashed by the recency bias, which is, well, it's been like this for the past 12, 14, 15 years. So it's always going to be like this. That nothing ever goes up and down. I mean, come on, guys. It's just so, I hate to laugh about stuff like this, People probably think I'm the most depressed person ever, but it's actually far from the truth. But when you're talking about serious stuff like this, how can you honestly crack jokes and laugh about it? It's serious as hell. Like, you're talking about people's livelihoods, people losing their livelihoods. I feel like that guy from The Big Short, what's his face? Oh, I forgot his name. It'll come to me after the stream. Ben Rickard. I feel like that guy because, you know, it's just not a time for laughing and joking. It's all seriousness. But anyway, guys, I hope you enjoyed the stream. I hope it was somewhat helpful. I hope it gave you some insight into what my thoughts are anyway. And just make your own financial decisions. Do your own research. Take everything I say, obviously, with a pinch of salt. I'm no expert. I'm no PhD economist at Goldman Sachs. But as you can see, and as you saw, even those guys get it wrong too. So anyway, guys, thank you so much for watching. Watch out for that video on the banks, and I'll see you in the next one, guys. Peace and love as always. Thank you all for being